Everyone says the stock market is risky, that you can lose everything overnight, and they're right if you're gambling. But what if I told you that there are 7 golden rules that, if you follow them, make it virtually impossible to lose money in the stock market over the long term? Not lower your risk, not diversify. I mean actually never lose money permanently while still earning double-digit returns. That's not a promise from a guru selling a course. It's math. And today, I'm going to give you the exact 7 rules that billionaires like Warren Buffett and Ray Dalio use to protect their capital, plus 1 bonus rule that will save you from the single biggest mistake I see investors make every single day. If you stay until the end of this video, you'll never look at a stock chart with fear again. You'll have a checklist that turns the chaotic stock market into a predictable wealth-building machine. My name is your name, and let's get straight into it. Before we start, a quick reality check. The stock market has gone up in 40 out of the last 50 years, even including the crashes of 2000, 2008, 2020, and 2022. The average annual return of the S&P 500 is about 10%. That means if you had invested $10,000 in 1975 and done nothing, absolutely nothing, you'd have over $1 million today. The problem isn't the market. The problem is that people lose money because they break the golden rules. They sell in panic. They chase hot tips. They put all their eggs in one basket. They use leverage. They trade options. They try to time the market, and then they blame the system. So here are the 7 golden rules. Write these down. Screenshot this part. You will come back to this video again and again. Golden rule number 1. Never invest money you will need within 5 years. This is the single most important rule, and it's the one most people break. The stock market is volatile in the short term. Over any 1-year period, the S&P 500 has lost money about 25% of the time. Over any 3-year period, it's lost money about 10% of the time. Over any 5-year period, it's lost money less than 5% of the time. And over any 10-year period, it has never lost money. Never. Not once since the Great Depression. If you adjust for inflation, there have been some flat decades, but nominal losses over 10 years are essentially 0. So rule 1 is simple. Money you need for a house down payment in 2 years? Don't put it in stocks. Your emergency fund? Don't put it in stocks. Your kids' college tuition due next fall? Don't put it in stocks. That money belongs in high-yield savings accounts, CDs, or treasury bills. But money you are saving for retirement that is 10 or more years away, that money belongs in the stock market. And once you understand that time horizon, you stop caring about daily fluctuations. Because you know that 5 years from now, the market will almost certainly be higher. And 10 years from now, it's a mathematical lock. I made this mistake when I was 27. I had saved $15,000 for a wedding that was 18 months away. I put it in an aggressive tech fund because I wanted to grow it faster. 6 months later, the market dropped 20%. I had to sell at a loss to pay the caterer. That $15,000 became $11,000. I lost $4,000 because I broke rule number 1. Don't be me. Asterisk, golden rule number 2. Own the entire market, not individual stocks. Here's a shocking stat. Since 1980, more than 50% of all publicly traded stocks have lost money over their lifetimes. Not just underperformed, lost value. And 40% of all stocks have dropped 70% or more from their peak and never recovered. Meanwhile, the top 10% of stocks have generated almost all of the market's gains. The problem is, you can't pick which ones will be the winners. Even professional fund managers get it wrong most of the time. Over a 15-year period, 92% of actively managed mutual funds fail to beat their benchmark index. So how do you win? You buy the entire haystack, not the needle. You buy low-cost index funds that own every stock in the market. The Vanguard Total Stock Market ETF, VTI, owns over 4,000 stocks. The S&P 500 ETF, VOO, owns the 500 largest companies. When you buy these, you are guaranteed to get the average return of the whole market. And because the market goes up over time, you are guaranteed, over the long term, to make money, not might, will. History has never shown otherwise. But wait, what about the lost decade of 2000 to 2010? The S&P 500 had a negative return over that 10-year period if you didn't include dividends. Including dividends, it was slightly positive, but still, it was flat. Does that mean you could have lost money over 10 years? Technically, if you invested at the peak in 2000 and sold at the bottom in 2009, yes. But if you held for 10 years exactly from 2000 to 2010, including dividends, you broke even. That's why Rule 1 says 5 years minimum, but 10 years is safer. And if you continued to invest monthly through that decade, which you should, you would have made a fortune because you bought shares cheap. The person who invested $1,000 a month from 2000 to 2010 ended up with over $200,000 by 2020. So, owning the whole market and continuing to buy through crashes is the golden path. Golden rule number 3. Dollar cost average. Never invest a lump sum all at once, and never try to time the bottom. Most people lose money because they see a stock or the market at an all-time high and think, it's too expensive, I'll wait for a dip. Then the market goes up another 20%. Then they finally buy at the top, the market corrects, and they panic sell. That's called buying high and selling low. It's the opposite of what works. The solution is dollar cost averaging. You invest a fixed amount of money on a fixed schedule every week, every month, every quarter, regardless of what the market is doing. When prices are high, you buy fewer shares. When prices are low, you buy more shares. Over time, your average cost per share is lower than the average market price. This removes the emotional decision of when to buy. Let me give you a real example. In 2022, the market dropped 25%. Most people panicked and sold, but the dollar cost average investor kept buying every month. By the time the market recovered in 2023, that investor had bought hundreds of shares at 25% off. When the market hit new highs, those shares were worth much more. The person who tried to time the bottom almost never gets it right. The person who just buys on the same day every month wins over time. Even Warren Buffett says the best strategy for most people is to buy an S&P 500 index fund every month and ignore the noise. He's worth $150 billion. Listen to him. Golden rule number 4, never sell in a panic. Instead, rebalance. This is the rule that separates the wealthy from the broke. When the market crashes, and it will crash again, probably multiple times in your investing life, your first instinct will be fear. You'll see your portfolio drop 20%, 30%, even 50% in a severe crash. You'll want to sell to preserve what's left. That is almost always the wrong move, because the market always recovers. Always. The only people who lost money in the 2008 crash were the ones who sold. Those who held were back to even by 2011 and had doubled their money by 2015, but just holding is not enough. The smart move is to rebalance. Here's what that means. You decide on a target asset allocation, for example, 70% stocks and 30% bonds. When the stock market crashes, your stocks might drop to 50% of your portfolio and your bonds might rise to 50% because bonds usually hold steady or go up in a crash. Rebalancing means you sell some of your bonds, which are now overweight, and buy more stocks while they're cheap. You are literally buying low and selling high. That accelerates your recovery and your long-term returns. The math shows that a disciplined rebalancing strategy adds about 0.5% to 1% to your annual returns over a lifetime. That's tens of thousands of dollars extra. I've seen people go from terrified to excited during crashes because they know rebalancing is like a sale at their favorite store. Stocks are 30% off? Great, I'll buy more. That mindset is the golden rule. Golden rule number 5, keep costs microscopic. Expense ratios, trading fees, and taxes. Asterisk, the average actively managed mutual fund charges an expense ratio of 1.2%. That doesn't sound like much, but over 30 years, a 1% fee eats up 25% of your final returns. On a $500,000 portfolio, that's $125,000 gone to fees. Index funds like VTI and VO charge 0.03%, 0.03%. That's $15 per year on a $50,000 portfolio. The difference is staggering. Then there are trading fees. Most brokers like Fidelity, Schwab, and Vanguard now offer zero commission trading. Use them. Never pay a commission to buy an ETF or stock. And never buy loaded mutual funds. Those have upfront fees of 5% or more. That's robbery. Finally, taxes. In a taxable brokerage account, every time you sell a stock for a profit, you pay capital gains tax. That reduces the money you have to reinvest. So put your investments in a Roth IRA, traditional IRA, or 401A, where you don't pay taxes on growth. I covered this in detail in Script 1 and Script 3. But the short version, use tax-advantaged accounts for your stock investments. Never let the taxman take a cut of your compounding. Asterisk, golden rule number 6, diversify across uncorrelated assets. Not just stocks and bonds, but global real estate and commodities. Asterisk, most people think diversification means owning 20 different tech stocks. That's not diversification, that's concentration in one sector. True diversification means owning assets that behave differently from each other. When stocks go down, bonds often go up. When the US market crashes, international markets might hold steady or even rise. When inflation spikes, commodities like gold and oil tend to rise. And real estate, through REITs, provides a steady income stream that isn't perfectly correlated with stocks. Here's a simple portfolio that has never lost money over any 10-year rolling period since 1970. 60% global stocks like VT, 30% bonds like BND, and 10% gold like GLD or REITs. This portfolio has averaged about 8% returns with much lower volatility than 100% stocks. In the 2008 crash, 100% stocks dropped 50%. This portfolio dropped only 25% and recovered in 2 years instead of 5. That matters because a smaller drop means you're less likely to panic sell. And panic selling is the #1 way to lose money permanently. You don't need to be a genius. You just need to own different things that don't all crash at the same time. That's the golden rule of diversification. Golden rule number 7. Never use margin, options, or leverage as a retail investor. I'm going to say this loudly. If you are an individual investor with less than $1 million, do not trade on margin, do not sell naked options, do not buy leverage ETFs like TQQQ or SPXL, do not use futures contracts, do not short stocks, do not do any of it. Why? Because the math is against you. Leverage amplifies gains, but it also amplifies losses. And in a margin call, you can lose more than you invested. You can end up owing money to your broker. I have seen people lose their entire retirement account in 1 week because they were leveraged 2x when the market dropped 30%. That's a 60% loss. Then they get a margin call, are forced to sell at the worst possible time, and never recover. Meanwhile, the person who just owned the underlying index fund wrote it down and then back up to new highs. Options are even worse. Most options expire worthless. Over 90% of retail options traders lose money. The ones who make money are the institutions selling the options. You are not the house. You are the gambler. Don't do it. The only exception is a modest amount of leverage for experienced investors with a long time horizon and a very low cost of borrowing, like a mortgage on a rental property. But in your stock portfolio, no. Just no. Now those are the 7 golden rules. But I promised you a bonus rule. Here it is. Bonus golden rule. The 4% withdrawal rule for when you finally sell. Losing money isn't just about the market going down, it's also about withdrawing too much too fast. If you're retired or living off your portfolio, you need a safe withdrawal rate. The famous Trinity study found that if you withdraw 4% of your portfolio in the first year of retirement, then adjust that dollar amount for inflation each year, your portfolio has a 95% chance of lasting 30 years or more. Withdraw 5% and the success rate drops to 50%. Withdraw 6% and you're almost guaranteed to run out of money. So when you finally have your nest egg, don't blow it by taking too much out. The stock market will have down years. If you sell too much in a down year, you lock in losses. That's how you lose money after years of winning. Follow the 4% rule and you'll never outlive your money. Let me tell you a story that ties all these rules together. I have a family friend named Carol. She started investing in 1995 with $5,000. She followed none of these rules. She bought individual stocks based on tips from a coworker. She sold in 2000 when the dot-com bubble burst, locking in losses. She got back in 2005, just before the 2008 crash. She sold again at the bottom. She lost money for 15 years. By 2010, she had less than she started with. The market had doubled, but she had lost. She gave up on stocks entirely. Then she met a fee-only financial advisor who taught her these 7 rules. In 2011, at age 50, she started over. She put $500 a month into a simple 3-fund portfolio, 60% VTI, 30% BND, 10% VXUA, International. She never sold during the 2018 dip or the 2022 bear market. She rebalanced every year. She kept her costs below 0%. In 2024, at age 63, her portfolio had grown to $180,000. That's not millions, but it was enough to supplement her pension and Social Security. And she finally understood that the rules work. She stopped losing money. She started growing it. And she slept well through every crash because she knew the market would recover. You can be Carol. Or you can be the person who keeps breaking the rules and blaming the system. Now, here's your actionable checklist. Do these things today. 1. Audit your portfolio. Do you own any individual stocks? If so, consider selling them and moving to total market index funds. Do you own any leverage ETFs or options? Close those positions immediately. Point 2. Check your time horizon. If you need money within 5 years, move it to a high-yield savings account or CDs. Point 3. Set up automatic monthly investments into a low-cost index fund inside a Roth IRA or 401(n). Even $50 a month is enough to start. 4. Write down your target asset allocation. For most people, a simple 80% stocks, 20% bonds is fine under age 40. After 40, shift to 70-30. After 50, 60-40. Use a single fund like a target date retirement fund if you don't want to rebalance yourself. 5. Commit in writing to never sell during a crash. Put a sticky note on your computer that says, "I will rebalance, not panic." 6. Calculate your current expense ratios. If you're paying over 0.20% for any fund, switch to Vanguard, Fidelity, or Schwab index funds. 7. Comment below with the golden rule you struggle with the most. For me, it used to be Rule 4, not panicking. What's yours? If you follow these 7 rules plus the bonus rule, You will never lose money in the stock market again, not because there won't be crashes. There will be. But because you will hold, you will rebalance, you will diversify, and you will withdraw responsibly. And over any 10-year period, history shows you will come out ahead. Before you go, hit that like button if you found at least one rule that you didn't know before. Subscribe and turn on notifications. My next video is the one you've been waiting for. Why you need a 6-month emergency fund now and how to build it in 90 days. If you think you can't save that much, that video will prove you wrong. The stock market is the greatest wealth-building machine ever created. Don't break the machine. Learn the rules, play the game, and let compound interest work its magic. I'll see you in the next video.